Are you falling for the prime rate trap in your CPA exam questions? Many candidates see extra data, panic, and calculate interest using the wrong percentage or the wrong principal balance. In this video, we are solving a classic notes payable problem from the CPA exam. I am going to show you exactly how to spot the distractors, calculate the accrued interest correctly after a partial payment, and get to the right answer in under 2 minutes. Let's dive in. Here is our scenario. On August 1st, 2025, Law Company issued a note payable to National Bank in the amount of $750,000, bearing interest at 6% and payable in 3 equal annual principal payments of $250,000. On this date, the bank prime rate was 3%. The first payment for interest and principal was made on August 1st, 2026. At December 31st, 2026, Law should record accrued interest payable of A. $18,750, B. $12,500, C. $9,375, and D. $6,250. Let's take a closer look. Interest rate 6%. Repayment 3 equal annual principal payments of $250,000. The first payment for interest and principal was made on August 1st, 2026. The trap. The bank's prime rate is 3%. First step. Take your mental red pen and cross out that prime rate of 3%. It is irrelevant. The note bears interest at 6%. Don't let the examiner distract you with market rates that don't apply to the contract. The question asks for accrued interest payable at December 31st, 2026. To get this right, we need to know two things. What is the outstanding principal balance during the accrual period? How many months have passed since the last interest payment? Let's look at August 1st, 2026. The problem states the first payment was made on this date. This is crucial because it changes our principal balance. On August 1st, 2026, we paid off $250,000 of the principal. Old principal $750,000. Less payment $250,000. New principal $500,000. This is the number we use for our accrual. Now count the month from the last payment, August 31st, 2026, to the reporting date, December 31st, 2026. August, September, October, November, December. This is exactly 5 months. So, the math is $500,000 new principal multiplied by 6% rate and multiplied by 5 months. 5 divided by 12. When we run the numbers, 500,000 times 6% gives us $30,000 of annual interest. Multiply that by 5 and divide by 12, and we get $12,500. Looking at our options, A. $18,750, B. $12,500, C. $9,375, and D. $6,250. The correct answer is B. $12,500. Did you catch the principal reduction? If you missed that payment on August 1st, you would have calculated interest on the full $750,000 and likely picked the wrong answer. Always draw a timeline for accrued interest problems. It saves points. If you want to master more CPA exam topics like this, make sure to subscribe to Accounting with Yana and check out my playlist on liabilities right here. See you in the next video.